Next year is going to be a spectacular year in terms of growth, in terms of bringing our country back. I think we're going to have a really good year. We want to be where we were, and I think we can actually surpass where we were.
Good afternoon. I'm Bob Costa, national political reporter at the Washington Post. Today, we continue the Washington Post Live's Path Forward series with two leading voices on the economy and finance. Later on, my colleague David Ignatius, he will interview Ray Dalio of Bridgewater Associates. But we begin this afternoon, Larry Kudlow, President Trump's chief economic advisor and director of the National Economic Council. Mr. Kudlow is in the president's inner circle, working with him on economic issues and challenges that have been sparked by this pandemic. And he's working with lawmakers, Treasury Secretary Steve Mnuchin, as the White House negotiates Congress. Larry, welcome back to Washington Post Live.
Thank you, Robert. Appreciate it.
Larry, how long will it take for this economy to recover?
To what?
To recover.
Well, look, I think you're going to have. Do I have this feedback thing? Maybe we can fix the feedback. I'm sorry, Rob.
No worries, Larry. Not easy.
But let me say, so much of this depends on the virus and the rate of business openings or the rate of life in general. So I'll give you the rough out scenario. We know as a consequence of the pandemic, the second quarter will be reported in about a month. It's going to be a very, very significant contraction. Alongside that, we've seen the huge increase in weekly unemployment claims. There's a lot of heartbreak here. There's a lot of hardship here. There's a lot of anxiety here. It's not, it's a very difficult situation. Now, I would suggest that the reopening job is a transition in May and June, and we're seeing some small glimmers of hope and growth, and I think there will be a substantial return to work in the summer. I think we'll see it, and I rather agree with the Congressional Budget Office most recent report. They're showing a very deep contraction in the second quarter with a very high unemployment. But on the other hand, showing a growth recovery, 16-17% in the second half of the year, and a pretty strong recovery in 2021, roughly 4%. Some of this depends on policies. Some of this, again, is going to depend on how efficiently and safely we can reopen the economy.
So, Larry, I appreciate you being patient with the Skype connection, not perfect, and I appreciate all the viewers being patient, but we're going to get through this, have a conversation. Appreciate your patience. Larry, when you talked about the CBO, you're inside the NEC. What's the model you're using on the economy? How are you getting data and processing it?
Well, we work very closely with the CA, and we use some of their models, and we use other models in the private sector. But I will say that the CBO numbers are in the same ballpark as private surveys or the Wall Street Journal surveys of forecasters or the so-called forecasters. And, this is an afterthought. I don't want to filibuster through this, but look, it's really hard to model a virus or a pandemic likes of which we haven't seen for 100 years. And there's so many variables that almost defy modeling. They're health variables. Uh, Businesses opening, whether they're large or whether they're small, there's got to be testing. There's got to be temperature taking. There's got to be best practices for cleanliness and washing your hands or rinsing off your hands every day. There's got to be hospital capacity. And there's got to be diagnostic testing. There's got to be tracing. So it varies. That's about all I can say. And we're just giving it our best bet. But I do feel that with the right policies and incentives, folks will return to work, and I'll just say fairly rapidly. And we'll see a pretty big pickup in the second half of the year on into next year.
In terms of that phrase, a pretty good pickup, President Trump recently said he expects a V-shaped recovery, his words. Do you share that assessment, and what backs up that confidence?
I do share that assessment. And again, the CBO numbers do too, and most of the private forecasters. Now, I suppose, Bob, you can have your own V. There's Vs and there's lesser Vs and there's combos of U's and Vs. But I mean, look, just to take the CBO, they've got 21.5% growth in Q3 and 10.5% in Q4. Those are numbers we can identify with, and they're not too far from what private sector people are saying. Now, in terms of, how the numbers coming in are not good. In fact, they're downright bad in most cases, but we're seeing some glimmers, perhaps. I will point to the stock market. I'd also point to more folks are driving. You see it in a rising Apple mobility index. Gasoline demand is picking up. In fact, gas and oil prices are picking up, particularly oil prices. I regard those as recovery signals. Housing demand looks better. Actual housing starts continue to fall at a significant pace, but housing demand, home builders, surveys, confidence, so forth, look much better. A lot of businesses are already opening just through the month of May as the states open. A lot of businesses are opening. That, of course, is hugely important. A lot of people believe there's going to be tremendous demand for automobiles, for cars. More folks are going to be driving. Now, the car companies are opening up their factories and trying to get the right mix of work return and safety, but that's also a good sign. Mortgage rates are low. In fact, interest rates are low in general. So it is not conclusive, Robert. I'm the first guy to admit that. I'm saying these are glimpses of a little bit of hope and growth, and we will see.
Do you expect the unemployment rate to be in double digits on election day in November?
I would say that's possible. It could come in slightly lower, but again, if I stay with the CBO, they're going to be very tough numbers.
When you tout the stock economy, Larry, and you also look at the jobless numbers, what's your message to that business on Main Street that sees Wall Street doing fine with the Dow above 24,000?
Well, listen, they're not totally divorced. I mean, a lot of Main Street people are in the stock market. That's kind of a lesser known fact. Pensions, government pensions, union pensions, those are Main Street folks who are invested in the stock market. And I don't know, about more than half of Americans invest in the stock market. But I also use it as a leading indicator. It may not be perfect. It did signal its decline in late February and early March was a signal that what we hoped would happen wouldn't happen, did happen, and the pandemic exploded exponentially. So it's something worth paying attention to. It's not the end all be all. There's a whole variety of leading indicators out there. I mean, look, let's go back to the president's rescue package, along with bipartisan support from Congress. I don't regard the package necessarily as stimulus. It was kind of even. Let's try to stabilize, even keel, cushion the terrible contraction. But we've had $3 trillion on the budget, and the Fed has spent about $2.5 trillion on their various lending facilities, with probably another couple of trillion to come. And the Fed has increased their balance sheet, their money supply. M2 is
Larry,
growing
does
at
the
20.
president want more action from the Fed?
No, the president's happy with the Fed. He called Chairman Powell, what was his award, Bob? The most improved player. Not the most valuable player, I guess, but most improved player. That's a tremendous award. So the Fed's done a good job, in my view. Again, their lending facilities, not all complete yet, but up and running in most cases, pouring a lot of liquidity. And they've increased their balance sheet with a 0 interest rate. The money supply is soaring. These are things, I don't regard this as long-term, incentives to grow, but I do regard them as short-term rescue package with bipartisan support. I think it was very important, just trying to get folks through this. I do believe,
support negative interest rates?
Oh, did you say do I?
Yes.
Who? I'll go with Powell on this at the moment. I don't think we need them. They've never worked in the countries they've been used. I don't want to spend a lot of time on it one way or another because I don't think it's that important. Sometimes the president talks about being competitive with negative rates. I think the liquidity is more important than the rates. And the Fed's balance sheet has grown by $2.5 trillion. And as I said, they've increased lending resources by another $2.5 trillion. So that's $5 trillion on top of $3 trillion budget assistance. That's a big number, Bob. That's $8 trillion. That's over 40% of GDP. And I think we did what we had to do. And I think now, as we wait and see a better assessment of the economic impact of those programs, when we come back to negotiations, as we undoubtedly will, I think it's very important that we move from rescue to reopening to more growth-oriented incentives for the medium and longer term. That's my own vision.
Larry, that puts you at odds with the Fed Reserve Chairman, who has testified and spoken on television about the need, in his view, for more congressional stimulus. Do you disagree with his position on that?
Well, look, if he's talking about, for example, a payroll tax cut, which the president favors, if he's talking about a possible exclusion, if you buy an asset in the next 6 or 9 months, you might get a capital gains exclusion. I'm not talking just about stocks. I mean, all assets, businesses, factories, oil fields. If you're talking about incentives to bring businesses home from China or elsewhere, if you're talking about large tax deductions for dining, entertainment, sports, and travel and tourism, these are all things the president has talked about publicly. Maybe a corporate tax reduction for people coming back to the U.S. If you're talking about liability restrictions and safeguards for COVID-19 charges for businesses, restaurants, small stores, those are all that could be characterized as fiscal stimulus. And in that sense, I would agree with you.
What about extending the $600 unemployment benefit? Could you support that as part of a deal?
Well, I don't want to, negotiate here.
Well, many Americans are wondering if they're going to get that check for an extended period.
I think many Americans want to go back to work. I think that's a very important point. And I think one of the things we learned, this is not a traditional macroeconomic recession because of the virus story. But I think we've learned in the last recession, the so-called Great Recession, that increasing and extending unemployment benefits are disincentives to work. I'd rather people went back to work. And, I'd rather, for example, that we provided a big incentive for workers with a payroll tax holiday, which would increase the worker side, increase after-tax take-home wages by 7.6%. We already have one on the business side. And by the way, the worker side payroll holiday helps businesses because it makes hiring a little cheaper. I'd rather we just took the regulations and all regulatory barriers down to help businesses grow. That's so important. The president announced a broad-based regulatory plan to help the economy and remove those barriers. There's lots of ways to do this. And I think we should employ down through the years what's worked and what hasn't worked. I do not believe, Robert, that more government spending is going to give us a strong and durable recovery. That's been tried before. Again, I think lower taxes, lower regulations, good trade deals to promote exports and reciprocity. That's what got this economy so strong in the 3 years and 2 months before the pandemic. I think that's what we should stay with and expand on those policies. Those are the growth incentive policies.
What about lowering? Look, I've been talking to my sources in both parties, and they say even if the White House doesn't want to agree to an extension of the $600 unemployment benefit, maybe it could be lowered as part of an agreement to $300 or $400, maybe a lump sum, maybe it's phased out over time. Are those discussions at least on the table as part of a deal?
Robert, there are lots of possibilities, permutations, and so forth. I don't want to negotiate here. Much as I admire your journalism work, I don't think this is the right spot. We'll see how this plays out. We will see.
And Larry,
there are
a
number of options. And as I said, we're sort of slowing down the process right now. We want to take a good look and assess the economy and the virus and the numbers and the flattening and so forth and the testing capabilities, all of which look much, much, much improved. And then we'll get on with the business of discussing future policy.
And one more thing about the deal that could be in the works. You didn't mention, Larry, money to help Michigan's budget, money to help Maryland's budget. Is just flat state aid something you're not considering at the White House as part of a deal when you say it has to be specific for COVID-related expenses?
Well, again, some suggestions on the policy side would be more targeted toward COVID-related funding and assistance, frontline workers, particularly. I think most of the equipment issues have been solved nicely. The testing issues have been solved nicely. But that's one thought. The president himself has said, first of all, he doesn't want to bail out poorly managed fiscal policies in some states. Doesn't want to bail out the pension funds. Those are non-economic recovery issues. They're non-COVID issues. He's also raised the point on sanctuary cities and sanctuary states, where he completely disagrees on the benefits and costs there. That's turning criminals loose makes no sense at all, and we certainly don't want to fund that. So there are a lot of issues here. I don't want to pronounce anything. I'm just saying, yeah, that's all on the table. But as you and I have
you've
talked,
heard Senator Graham, Larry, talk about infrastructure. Could that be on?
I'm just going to say the most important things in terms of divining where we may go is what the president himself is saying. And he's talked at some length about a lot of these options. I'm sorry. Lindsey Graham wants infrastructure. Is that what you're saying?
To you.
Yeah. I mean, we have had a lot of different infrastructure policies in the NEC working in the interagency process. We have a lot of plans. You've got a pretty good bill from Senator Barrasso. Transportation Department, Elaine Chao's gang Their team has developed plans. NEC has weighed in, and so have other agencies. So the president himself, from time to time, has been talked a lot about infrastructure. So that could be on the table. I'm saying could. I'm not making pronouncements here. This is all pre-decisional.
We got a question from one of our readers, Larry, John Laughlin from New Jersey. He asks, how much national debt can the U.S. tolerate? As you look at all these spending packages, are debt and deficit issues on your mind?
You know, in an emergency crisis situation like this, with the health and well-being of the country at stake, I think adding debt, presumably for good purposes, and I think the phase 3 package was for very good purposes, don't get me wrong. I don't think we can spend our way out of this forever, but I think that one was very essential, and thankfully it was bipartisan. But no, I'm just at this juncture, no, I think the financial markets, the bond markets have shown a very strong appetite for Treasury issues. The financing rates, as you know, are very low, more or less 40 or 50 or 60 basis points, less than 1%. You know, it's like a half of 1%. This is a good time to do that. And I think that the U.S. has done this in the past and during emergencies. World War II comes to mind. I think we'll be just fine in our financing. And I will add what I say frequently, because I've heard a lot of incorrect things regarding international relations. The full faith and credit of the United States debt obligations is absolutely sacrosanct. We will never tamper with that.
We've gotten a lot of questions too, Larry, about housing and mortgages. Lee Sand Butterfield from Oregon asks, what is the expected impact on housing prices this recession type period?
Well, interestingly, a couple things. Number one, housing prices in the aggregate nationwide have not moved much. They're still rising at more or less 4% or so. So there's been no meltdown in housing prices. A lot of other assets are down 30, 40%. So that's one point. Second point is, although new housing starts and sales have plunged with the overall contraction, new home building, same way. But the confidence indexes from the Home Builders Association show a lot of housing demand. That's an interesting point. We'll see if it pans out, but a lot of housing demand. So I think that's a plus. And let's not forget, mortgage rates are rock bottom, absolutely rock bottom. So that's a favorable omen. What needs to happen is income needs to start rising again. Jobs, income, businesses, and the overall economy. And I think, again,
would you support the federal government ever stepping in to shore up the mortgage services company?
I beg your pardon?
Could you see the federal government ever stepping in the coming weeks to shore up mortgage services companies?
Well, we've looked at that, and actually a number of rules and regulations have been loosened to help them. Unfortunately, there's been mortgage forbearance, but conversely, you know, the action is bad, but people are not losing their homes and mortgages. There's enormous forbearance going on across the country regarding mortgages, enormous. And then I've seen some recent surveys that the rate of forbearance is coming down. That's one of those glimmers of hope and growth. So we have tried to help the mortgage servicers through a deregulation route.
Larry, just have a few more minutes here to wrap up on the China trade deal. With the pandemic changing the global economy, do you have any interest in consulting with the Chinese about making changes to the deal?
Phase 1 is intact. Ambassador Lighthizer believes that it's proceeding. I guess the Chinese commodity purchases are a little far behind, but I think that's more because of poor economic and market conditions. Recently, there was a conference call with Vice Premier Liu He and Secretary Mnuchin and Ambassador Lighthizer, and they reported to the president that the deal is intact and China has every intent of implementing it.
There is a natural disasters clause, as you know, in the agreement. Could that ever be used to renegotiate at this turbulent time?
At the present time, Bob, I would say there's no renegotiating at all. We're looking for steady implementation, and we'll be monitoring it very closely. I think once our economy opens up and a ditto for China and business returns to something closer to normalcy, we will have an export boom in the United States. We're competitive and productive. So I think there's an export boom that will boost growth in the years ahead. The USMCA deal with our neighbors in Canada and Mexico is a very good deal that will add substantially to GDP, jobs, homegrown products, technological innovation. So I know it seems very distant, but last December and January, we signed two bang-up trade deals, even leveling the playing field, fairness, reciprocity, with tremendous advantages to the United States, whether you're manufacturing, auto workers, farmers, ranchers, technology workers. Those things will be implemented. And I know it's a long time ago, it's just really a few months. Once things come back into play in the economy, I think those deals are going to provide a lot of jobs and a lot of economic growth.
Final thing, just to follow up, are you satisfied with China's compliance with the deal?
I'm okay with their compliance with the deal. I listen and take my lead from Bob Lighthizer. I'm not satisfied, not in anything close to being satisfied with China's behavior regarding the pandemic, the lack of information and transparency, the continued concealment, in cahoots with the WHO. The president has said this again and again, and I surely support it. Chinese behavior regarding the pandemic has been disappointing, tragically so, and they will be held accountable as investigations go on. They will be held accountable, and that's the watchword. But what
does that mean, though? Held accountable?
Well, we will see when our investigations are concluded what accountability means. But every country, every civilized country must be held accountable for their behavior as it impacts. I mean, you know, part of this accountability you've already seen with respect to our treatment of Chinese companies, publicly held companies on our exchanges, the level of fraud, the lack of transparency, the failure for investor protections, that has to be changed. We've already made changes with the thrift savings plan. We're not going to have Chinese investments. There are other bigger issues with Chinese companies losing money and showing how much fraud was in stake. The virus is going to be the biggest one because that was the most painful, and we are still looking into that. As you know, we've ceased funding the World Health Organization for a time. So we'll see what our investigations come up with, but they will be held accountable.
Larry Kudlow, thank you very much for your time. It's appreciated.
I appreciate it. Thanks, Robert.
And thank you all for watching that conversation as part of our Path Forward series. Stay tuned. In a moment, my colleague, David Ignatius, will be up next. He will interview Ray Dalio from Bridgewater Strategies. Stay tuned. Stay tuned.
Welcome to the second half of our economic doubleheader. I'm David Ignatius, a columnist for the Washington Post, and it's my pleasure in this segment of the Path Forward to have a chance to speak with Ray Dalio. He is the founder and co-chairman of Bridgewater Associates, the largest hedge fund in the world with about $150 billion under management. It's one of the most knowledgeable and successful people in our global economy. We're going to talk today, unlike Larry Kudlow, the National Economic Advisor, not about the short term, but about the longer term issues and some fascinating ideas that Ray Dalio has developed, which I'll mention in a minute. But Ray, I want to just begin by asking you to comment on what we just heard from Mr. Kudlow. He's very much in the economic driver's seat in the White House, trying to think about these issues. And he talked about an economy that by the second half of the year will be coming back strongly. He also talked about the extraordinary commitment, $5 trillion in lending authority from the Fed and $3 trillion in fiscal spending approved by Congress. That's a lot of money, by his estimate, 40% of the GDP. Start us off before we get to the longer term issues by just giving us a sense of how you react to what you hear from Larry Kudlow in the White House.
Well, I think he started off by explaining that he really didn't know very much about whether there's going to, how the virus will transpire. I think that was very realistic. So he acknowledged that there was a wide range of possibilities, and that's the case. And then as he said, there could be a V and there could be a W, and who knows. And then they have to pick one, and so there's a congressional budget office. But I think the uncertainty around that is clear. There's a lot of uncertainty. Regarding the creation of the money and credit that's been produced, I think it's important to realize that for every individual, every company, and every government, there's a certain amount of revenue and income, and they have a certain amount of savings. And this economy, this downturn, produced a hole in income and a hole in balance sheets. And if those holes were not filled in, the economic consequences of that would be devastating. And so we estimate that there'll be $4 to $5 trillion, roughly speaking, in losses that come in the United States, indirectly or directly, and that the amount of filling those in quickly has made a big difference. However, it brings into question what the value of money and credit is. So there's been a lot of money and credit produced, and that will have implications longer term. So when we look beyond the immediate and we hear the sort of questions that have been asked dealing with tax cut changes and so on, I think we're going to come into an era in which the value of money, there are limits to the capacity to print money and maintain the value of money. And there are going to be questions that are capitalist versus socialist type of questions in terms of how the bill is divided and how what the world looks like in the future. Those things will take place in the future. So I think his assessment was right, but I don't think we're yet talking about the big things that we need to talk about.
We're going to turn to those big things. I just want to take one more minute to ask a more immediate question. I've heard people wonder whether what we're living through now, both the pandemic and the enormous economic dislocation of the shutdown of the world economy, should be likened to a tornado which sweeps through and does enormous damage, but then is gone, and you rebuild, or an earthquake which leaves behind rubble that can take years and years to rebuild. So I just would put that to you, Mr. Dalio, when you think about this, do either of those fit better, the tornado or the earthquake analogy?
First of all, I think that in both of those cases, they're apt. And whether we call it one or the other, there's a great deal of economic damage which will remain and will require a lot of repairing after this. I think what you mean is whether there are structural fissures and whether those will be deep And I believe they are. And that's why I think that there are three big factors that exist today that did not exist since the 30s, that are those things that create those fissures. I think those three big things that is the setting that this downturn has happened in is, first, we have a debt monetary situation that did not exist since the war years. In other words, when interest rates hit zero and you have a lot of debt and you have to print a lot of money, that changes the game. It means that it's not easy to stimulate an economy by monetary policy in the usual way, and you have to deal with the debts, and you're in a debt monetization mode. So that's one factor that you have to go back to the 30s. The second big factor, that's the lay of the land that we will remain with, gap between socialism and capitalism and Republicans and Democrats and so on. And that wealth gap issue, when you have an economic downturn at the same time, is particularly difficult. And the third factor that didn't exist before, but it existed in the 1930s, which is a concern, is the rise of a power to challenge the existing world power, the rise of China to challenge the United States, in which case there's a lot to argue or fight about, and that's the backdrop. So a downturn would have come from one reason or another. They always come. And those structural issues are the big important issues. And the 1930s gives a good case if we look at those. And if we look at the sizes of the debt and the printing and so on, that's also, as Larry Kudlow said, comparable to the war years. So I think that that will drive the nature of what's to come.
So, Ray, let's unpack those big ideas. I want to urge viewers who are interested in this systematic, deep analysis to look online for the detailed account that Ray Dalio has put together called The Changing World Order. You can find it either on LinkedIn or you can go to principles.com and find this argument systematically. But maybe we could unpack this one by one in your analogies to the 1930s and the terrible problems then, and then the consequential subsequent problems, starting with the debt problem. You've written that we're late in a cycle of indebtedness that was dangerous in itself. Talk a little bit more about what happened in the 30s and why the situation now, in your mind, simply on this question of debt and monetary policy is similar, and what we should do about it.
Well, under a normal set of circumstances, debt is spending power, and central banks can pretty much push a button, it turns down, and you hit it with a dose of stimulation, and it inflates, and you have the economy turning up. And that happens in an early part of a debt cycle. And then you get over indebted, and it's not so easy. So when from 1929 to 1932, there was a debt crisis because we had a lot of debt, and they had to ease monetary policy as a result of a debt bubble in the 20s. And then you hit zero interest rates. And when you hit zero, you can't use those monetary policies anymore. So then there is the printing of money and buying of financial assets. So that same thing happened in 2008 and 9. We had a debt crisis. We hit zero interest rates all around the world pretty much. And that first monetary policy of interest rate cuts doesn't work anymore. So they go to the second, which they did in 1933, and we did in 2008, and we did it again now. and that is the printing of money and buying financial assets. The first attempt at that was the turn up in 2008 and 9, and they bought bonds, and that passed through the system. And what it does is it tends to increase the wealth gap, because those who own financial assets benefit more than those who don't. And so financial asset prices go up and so on. But there's then another downturn. And in this particular downturn, like the ones in the 1930s, it was not good enough to be able to buy bonds and traditional assets. They needed to get money in the hands of businesses and individuals and so on, which could not any longer be done by the Federal Reserve buying bonds or other central banks buying bonds. So there had to be a coordination between the Federal Reserve and the federal government. Central governments can't print money, but they can determine, they can borrow money, and they can determine, and they can tax, and they can determine where that money goes. Central banks can't determine where it goes, but they can create money. And so we're in a new era. This new era is not the same type of capital allocation as existed before. You know, before, a central bank would put money on deposit, and then bankers would come along and they would say, oh, who can I safely lend to and make a spread? And that's how the capitalist system worked. We're now having the allocation of money and credit take place through the central government and not that allocation process. So that's, again, very much like the 1930s.
So those are disturbing historical analogies, and it gets worse in your assessment in your Changing World Order paper. You note that the 1930s saw this wealth and opportunity gap increase in the United States and around the world, so that people began to embrace more extreme ideas, communism, socialism, and the conservative equivalent in Germany and Italy. And you've written that you see similar gaps and consequent populist movements today. Talk about what your own assessment is of where we're heading in the kind of political economics of this crisis, thinking about what happened so many years ago.
Well, when you have a lot of debt and you have a wide wealth gap and you have an economic downturn, that's a toxic combination because it's a lot to fight over. And so throughout history, not just in the 30s, but even throughout history, that mix has caused a lot of confrontation. And so I think it's apparent that we're there. The elections will be that. I think it's apparent that we're going to have all around the world, we're having these fights of ideology, and what are they fights over? It's always, how do you divide the wealth? And how do you, it's a fight over wealth and power. And so I think we're in an environment where you have this downturn, you have the larger debts, and you have this ineffective monetary policy. That's a dangerous set of circumstances. So as far as looking ahead, I think that after this passes, there will be lots of negotiations or arguing about how to divide the pie or how to increase the pie. So when you hear, for example, Mr. Kudlow give the example of a capital gains tax reduction, that would be favored more by those who are more conservative and capitalist, and then you'll hear another plan in another format. I think the big issue domestically and internationally is, can we do this together without fighting and doing ourselves more harm than good from fighting? I would love to see a bipartisan, thoughtful disagreement negotiation, which did take place in providing the initial supports, financial supports. If we can handle these challenges well among ourselves and make our country greater to do the right things to make it more efficient, we can increase the size of the pie and divide it well. But there are real issues here in terms of the wealth, and I call it the opportunity gap. I'm involved, my wife and I are involved in Connecticut and kids' education. And you see, for example, the digital divide. There was no ability of poor kids to have computers to learn with, and the state won't fund it. And so, and there's not connectivity. Today, to not have connectivity is the equivalent of not having electricity 50 years ago. So such things are counterproductive and not fair. You know, the top, I did the analysis of deciles of people. The top 40% compared to the bottom 60%. Top 40% on people, but it's you want to educate your children in the best possible way. So these types of issues exist, and how we approach them, whether it's together in a thoughtful, empathetic way, realizing that the conflict would be too bad, is going to be the most important issue, I think.
So I think it'll interest our viewers that Ray Dalio, who founded, as I said at the outset, the largest hedge fund in the world, long before the COVID-19 pandemic and the lockdown of the economy, was arguing that something fundamental needed to be changed to avoid the consequences of the growing inequality in our society and the political dysfunction that was part of it. And maybe, Ray, you just speak a little bit about that. You wrote a paper last year. I wrote about it in a column, and the title, as I remember it, was How and Why Capitalism Needs to Be Reformed. And in other words, the fundamentals of the fairness of this distribution of the pie were bothering you a lot a year ago.
You know, everything needs to be reformed. Everything needs to be getting better. And I think the question is, are the outcomes what you want the outcomes to be? And if you're getting the outcomes, but the question is, what is the American dream? And when I grew up, I was lucky enough to, have two parents who cared about me. I went to a public school, and I came out with equal opportunity. And so there are things in which we would say, what is the American dream? I don't know if we could agree on it, but I would say it's something like equal opportunity. And are we producing equal opportunity? And by what metrics would we say we're producing equal opportunity? I don't think we are. I know we're not. I deal with it every day. And so that problem, when looked at a historical context, is not only an issue of fairness in terms of achieving your goal, but it's also an issue of the existence of the system. There are a lot of people today that will criticize capitalism and throw out capitalism and go to something that could be a lot less productive. And so to understand that there are the profit-making system can do a lot. It's still the best asset allocation system, best resource allocation system that there is, but it still does not fully achieve the goals that one might have in terms of equal opportunity. For example, if businesses want to make profits, and let's say people who have a lot of money can pay more for their kids' education, then the profitable thing to do is to appeal to them, and they will have better education for their children. And if states or school districts that are funded rely on the local tax basis, then they won't have that. That's just a particular of the system. So I believe there's the possibility to, if it's smart and bipartisan, to design it so the pie increases, that productivity increases, as well as divided well, because at the end of the day, giving money away is not going to raise productivity and increase the pie. So you have to increase the size of the pie and divide it well. And that has to be done in a smart and bipartisan way.
It does seem clear as we look at the extent of dislocation now and think about the future that a different economy in some respects is going to emerge after we get through this period of pandemic and lockdown. And one of the factors that we'll think about most is the third in your fundamental analysis, and that is the rise of a new competitor, the likes of which we really have never encountered in my judgment. And that's a China that will soon be not just as rich as we are, but as technologically sophisticated. During the years of Soviet threat to the United States, nobody ever imagined that they'd win the contest of ideas or that they really were a pure competitor in terms of science, technology, that range of issues. China is different. And perhaps you could just walk us through, Ray, your assessment of what this growing China will mean for a global economy that's been interdependent, but with American leadership.
Well, again, history provides a good guideline, but I started to go to China in 1984, mostly because I was curious, and I've gone through it over the years. And there's no doubt that their system is impressive. Has produced fabulous results in that. If you look at economic statistics, it went from 2% to 22%. The per capita income, let me say that again. Per capita income increased by 22 times. The poverty rate went from 88% to less than 1%. The development of technologies, the competition in terms of all of these things has been quite something. And so it is a viable competitor, and it is going global, and it has a lot of money. There's about $3 trillion in reserves. And so if you look at the amount of trade in the world, China's bigger in world trade. If you look at the amount of money that they're investing around the world, big, very big, bigger than the United States is in the sense. So what you have is China growing, being successful, and going international. And naturally, that produces a lot of economic competition and maybe beyond economic. So there are four kinds of wars or conflicts that exist with China. First is a trade war. There's then a technology war. There's a geopolitical war. You will see more about that in Hong Kong and Taiwan and issues in terms of that expansion. And there could be a capital war. There are signs of a capital war, as, for example, the president prohibits or discourages others from investing abroad and has the unilateral power to basically say that we won't pay China's debts, which are China's holding something like $1 trillion of our bonds. So there are a lot of issues to fight about. And just like domestically, the question is how bad that fight will be, or whether there are ways to be tough negotiators with each other and not get into a fight.
So I want to again encourage viewers who want to think about this more carefully while we still have a little time before heading back to work, most of us, to go online and look at Ray Dalio's thoughts on the changing world order, as he puts it. Ray, I want to take the few remaining minutes we have to talk a little more informally. For our viewers, this is a rare chance to see someone who started such an extraordinary business as Bridgewater. And our viewers, like people everywhere, are kind of wondering what's ahead, wondering what to do with their money, wondering where the financial markets are going. We've talked about this in big overarching terms, but maybe you could just speak a little more practically to people who don't get a chance to listen to the head of Bridgewater Associates very often.
Well, I'd say the two most important things are, first of all, to have a large enough savings, and I'll talk about that in a minute, and then to have it extremely well diversified. Okay, so large savings. I think everybody should calculate, if they didn't have an income, how much their expenses are, and then they look to their savings and they say that will last a certain amount of time, all things being equal. And the big differentiation, even today in the world, between countries is those who have enough savings to absorb the shocks that might come. So that's important. But what you save in is very important. And I think if we look back on the history, we may exclude the implications of the value of the dollar. So we pay attention to stocks and bonds and private equity or whatever, real estate. And those are things that do well in a normal economy. But you have to think, how do you go out globally and diversify into some other asset classes just a bit, a little bit of gold, a little bit of inflation index bonds, a little bit of European or other investments in, maybe even in China. I believe that investing in China is a good diversification strategy in this competitive kind of environment. So I would say savings and a plan that means the stock market is a bet on growth that doesn't have rising interest rates in it. If we get more growth than expected and we don't have rising interest rates, stocks will go down. And if the go up, and if the opposite is true, then they'll go down. So to think about those things, diversification and having enough would be my recommendations.
So, folks, you heard it from the master, Ray Dalio, the founder of Bridgewater Associates. It's been my pleasure to have this chance to talk with Ray about the economic crisis we're experiencing and the path forward, but in a very broad context. And Ray, I thank you for thinking carefully and systematically with us. So I want to tell viewers that we'll be back at Washington Post Live next week with a full slate of events. On Friday of next week, I'll be talking to Larry Summers, the former Treasury Secretary, and Gordon Brown, the former British Prime Minister. Next week, we'll also be talking on Wednesday to the CEO of Land O'Lakes, Beth Ford, and on Thursday to the CEO of JetBlue, Robin Hayes. So we hope everybody will be thinking about the economy, thinking about getting back to work as soon as possible. Again, thank you so much for joining us today for our discussions with Larry Kudlow and Ray Dalio.